There is a number that almost nobody is watching right now, and by the end of this video, you will understand why that number matters more than almost anything else in the financial world today. It is not a stock price. It is not a headline. It is a quiet shift happening inside the vaults of central banks, in the bond markets, and in the balance sheets of the world's largest institutions. And history tells us that when this particular shift has happened before, it has preceded some of the most significant repricings of money itself that the modern world has ever seen. I want to walk you through this slowly, carefully, and honestly, not with hype, not with fear, but with the kind of patient reasoning that has, time and again, separated investors who preserved their wealth through turbulent decades from those who didn't. So before we go further, comment below and tell me where you're watching this from and whether you currently hold gold, silver, or cash. I read these and I want to know what the world actually looks like from where you're sitting, because the answer varies more than people assume. Let's start with a simple truth that most financial media glosses over. Money is not wealth. Money is a claim on wealth. It is a receipt, a promise, a unit of account that only has value because enough people agree to trust it. Gold and silver, on the other hand, have never needed anyone's permission to be valuable. For over 5,000 years, across empires, currencies, and collapses, they have quietly done one job. They hold their value when the promises attached to paper money begin to break down. And right now, if you look closely at the plumbing of the global financial system, you can see the early signs of exactly that kind of strain building. To understand why, we have to go back to basics, not because you don't understand economics, but because the fundamentals explain everything that follows, and skipping them is how most people miss the bigger picture entirely. Every modern economy runs on debt. Governments borrow to fund spending, corporations borrow to expand, and households borrow to buy homes and cars. This is an inherently bad, controlled, productive debt has built highways, hospitals, and industries. The problem emerges when debt grows faster than the economy's ability to produce the income needed to service it. When that happens, a government essentially has four choices: raise taxes significantly, cut spending significantly, default outright, or inflate the currency so the debt becomes easier to pay back in cheaper dollars. Historically, the fourth option is chosen far more often than politicians ever admit in advance, because it is the least politically painful in the short term, even though it is often the most damaging in the long term. This is where the Federal Reserve enters the picture. The Fed's primary tools are interest rates and the size of its balance sheet. When the economy slows or credit markets seize up, the Fed lowers interest rates to make borrowing cheaper, encouraging spending and investment. When inflation runs too hot, the Fed raises rates to cool demand. In theory, this is a balancing act. In practice, over the last 2 decades, the Fed has increasingly found itself trapped between two competing fires: inflation on one side and an enormous, highly sensitive debt load on the other. Raise rates too aggressively, and the interest cost on that mountain of government debt becomes unsustainable. Cut rates too aggressively, and inflation risks reigniting. This tension is not a conspiracy, it's arithmetic. And arithmetic, unlike sentiment, does not change based on who is in office or what election cycle we're in. Now here's where it gets interesting, and where gold and silver come back into the story. Throughout history, whenever a major economy has faced this exact bind, too much debt, structurally persistent inflation, and a currency losing purchasing power, one asset class has consistently reasserted itself as a store of value: monetary metals. Not because of superstition, but because gold and silver cannot be printed. Their supply grows slowly, predictably, through mining, not through a policy decision made in a meeting room. That scarcity is precisely why, when confidence in paper currency erodes, capital tends to migrate toward assets whose value doesn't depend on anyone's promise. This is not theoretical. Let's look at history honestly, without exaggeration. In the 1970s, the United States faced high inflation, a weakening dollar following the end of the gold standard in 1971, and a series of oil shocks that rattled global markets. Over that decade, gold moved from roughly $35 an ounce to over $800 an ounce at its peak, an extraordinary revaluation that reflected collapsing confidence in the dollar's purchasing power, not some random speculative mania. Silver, historically more volatile than gold because of its dual role as both a monetary and industrial metal, moved even more dramatically in percentage terms during that same period. Fast forward to 2008, the global financial crisis exposed how fragile the banking system had become, built on layers of leverage most people didn't understand until it collapsed. In response, central banks around the world launched unprecedented rounds of monetary easing, injecting liquidity into the system at a scale never seen before. Gold again responded by climbing significantly over the following years as investors sought an asset outside the banking system itself. I'm not telling you these stories to suggest that history repeats perfectly. It doesn't, but it does rhyme, and the conditions we see today share uncomfortable remarkable similarities with both of those periods: elevated government debt relative to GDP, persistent structural inflation pressures, and a Federal Reserve navigating an increasingly narrow path between financial stability and price stability. Let me introduce you to someone, and I want to be upfront that this is a fictional but realistic story meant to illustrate a pattern many long-term investors will recognize. Her name is Elena. She's 58, and in the early 2000s, she worked as a school teacher who had spent nearly 2 decades quietly saving into a diversified portfolio her father had helped her set up before he passed away. That portfolio included a modest allocation to physical gold, something her father insisted on, even though at the time it seemed almost old-fashioned to her. When the 2008 crisis hit and she watched colleagues panic sell their retirement accounts near the bottom of the market, Elena did something different. She didn't sell anything. She simply held. Her equities eventually recovered over the following years, and her gold allocation, small as it was, had cushioned the portfolio's overall decline during the worst months of the crisis. The lesson wasn't that gold made her rich. It didn't. The lesson was that it gave her the psychological stability to avoid panic selling everything else at exactly the wrong moment. That stability, more than any single asset's return, is often the real value of holding monetary metals. This brings us to something crucial: the psychology of fear and greed, and why understanding your own brain is just as important as understanding the Federal Reserve. Human beings did not evolve to make rational decisions about abstract numbers on a screen. We evolved to survive immediate physical threats. When markets fall sharply, the same neurological pathways that once triggered a response to a physical predator, the amygdala flooding the body with cortisol and adrenaline, activate in response to falling account balances. This is why investors so often sell at the bottom when fear is highest and buy at the top when greed and euphoria are highest. It isn't a lack of intelligence. It's biology working exactly as it was designed to, just applied to a context evolution never prepared us for. Understanding this doesn't eliminate the feeling, but it does allow a disciplined investor to recognize the feeling for what it is, pause, and make decisions based on evidence rather than adrenaline. This is also why central bank behavior matters so much as a signal. Central banks, unlike retail investors, generally don't operate on fear or greed. They operate on long-term strategic positioning, often over years or decades. And what we've observed in recent years is a clear, publicly documented trend. Central banks around the world, particularly in emerging economies such as China, India, Turkey, and several others, have been net buyers of gold at levels not seen in decades. According to World Gold Council data, central bank gold purchases have hit multi-year highs, with many of these institutions explicitly citing diversification away from dollar-denominated reserves as a strategic goal. This isn't speculation on their part. It's a slow, deliberate repositioning by the very institutions that manage national reserves, and it tells us something important about how sophisticated, patient capital is thinking about the future of currency and reserve assets. Now let's talk about why this matters for the dollar specifically, and why currency strength and weakness sits at the center of this entire conversation. The US dollar has held a unique position since the end of World War II as the world's primary reserve currency, used for the majority of global trade and held as reserves by central banks worldwide. This status grants the United States what economists sometimes call an exorbitant privilege, the ability to borrow more cheaply and run larger deficits than most other nations could sustain, because global demand for dollars remains structurally high, but privilege isn't permanent. It's earned through trust, and trust is a function of fiscal discipline, monetary credibility, and geopolitical stability. When any of those three pillars weakens, the incentive for other nations to diversify away from dollar dependency grows stronger. We're not talking about the dollar collapsing overnight. That would be sensationalism, not analysis. We're talking about a gradual, multi-decade rebalancing that appears to already be underway, visible in central bank reserve diversification, in bilateral trade agreements that bypass the dollar, and in the steady accumulation of gold by nations seeking a reserve asset with no counterparty risk. Geopolitical risk compounds this further. When trust between major powers weakens through trade disputes, sanctions, regional conflicts, or shifting alliances, nations become understandably cautious about holding reserves that could, in theory, be frozen or restricted based on political decisions made by another government. We've seen this dynamic play out in real documented events over the past several years, and it has accelerated the very trend we just discussed: central banks seeking assets outside the direct control of any single nation's political system. Gold sitting quietly in a vault answers to no government's foreign policy. Let me tell you about another investor, and again, I want to be clear, this is a fictional composite designed to illustrate a lesson, not an actual case. His name is Marcus. He's 34, a software engineer who came into investing during the extraordinary bull run of the past decade. Marcus had understandably developed a mental model where markets simply went up, because that had been his entire experience as an adult investor. When inflation surged and the Federal Reserve began raising interest rates aggressively, Marcus watched his growth-heavy portfolio decline sharply, and in a moment of panic, he liquidated a significant portion of it near the low, moving heavily into cash. Over the following 2 years, as inflation eroded the purchasing power of that cash and markets eventually stabilized, Marcus realized the mistake wasn't holding too much risk initially, it was having no ballast in his portfolio, nothing that behaved differently than his growth assets when conditions changed. This story isn't a cautionary tale about tech investing, it's a cautionary tale about the danger of a portfolio built entirely on one economic assumption continuing forever. If you're finding this useful, take a moment to like this video and subscribe, because I promise you, the final insight we're building toward ties every single piece we've discussed together, the debt cycle, the Fed's dilemma, central bank buying, currency dynamics, and investor psychology into one conclusion that I think will genuinely change how you look at the next several years of markets. Stay with me. Let's now talk about silver specifically, because it behaves differently than gold in ways that matter enormously for understanding where we are in this cycle. Silver carries a dual identity. It is both a monetary metal with the same historical role as gold in preserving purchasing power, and an industrial metal used extensively in electronics, solar panel manufacturing, medical equipment, and a growing list of green energy technologies. This dual nature means silver often lags gold in the early stages of a monetary revaluation, because industrial demand and investment demand pull in different directions depending on economic conditions. But historically, once a monetary revaluation cycle gains momentum, silver has often outperformed gold in percentage terms, precisely because its market is significantly smaller and more sensitive to shifts in investment flows. This is sometimes referred to by analysts as silver's historically higher volatility relative to gold, and it's worth understanding both the opportunity and the risk that volatility represents. It is not a guarantee of outperformance, it is a pattern observed in prior cycles, and prior patterns are not promises about the future. Now let's bring in the bond market, because bonds and monetary metals are more connected than most people realize. Government bonds represent a promise. Lend the government money now and receive fixed interest payments plus your principal back later. The value of that promise depends entirely on two things: the government's ability to repay and the currency's purchasing power at the time of repayment. When inflation runs higher than a bond's yield, the real inflation-adjusted return on that bond turns negative. This is what economists call financial repression, and it has historically been one of the quieter ways governments manage down large debt burdens by allowing inflation to erode the real value of what they owe, effectively transferring wealth from bondholders and cash savers to the government itself, without ever needing to pass a visible tax increase. When investors begin to sense this dynamic playing out, demand for bonds as a safe long-term store of value weakens, and capital often seeks alternatives that aren't dependent on a government's promise to repay in a currency that may be losing value. This is precisely the mechanism through which persistent deficits, rising debt to GDP ratios, and an accommodative Fed can quietly push long-term capital toward gold and silver, not out of fear, but out of rational portfolio construction. I want to pause here and be very clear about something, because intellectual honesty matters more to me than building suspense for its own sake. None of what I'm describing is a certainty. I am not telling you that a currency collapse is imminent, or that markets will crash next month, or that gold is guaranteed to double in value. Anyone who tells you they know exactly what will happen and when is not being honest with you, whether they're bullish or bearish. What I am telling you is that the structural forces we've walked through, unsustainable debt trajectories, a Federal Reserve caught between inflation control and financial stability, central banks visibly diversifying into gold, and a shifting geopolitical landscape are documented, observable, and historically associated with periods where monetary metals have played an increasingly important role in preserving wealth. Recognizing a pattern is not the same as predicting an exact outcome. Prudent investors position for possibilities, not certainties.
Let me share one more story, and once again, this is a fictional illustration, not a real historical account. Her name is Priya. She's 46, and she runs a small logistics business. Priya isn't a full-time investor. She has neither the time nor the interest to watch markets daily. Years ago, she made a simple decision based on advice from an older mentor to allocate a modest fixed percentage of her savings to physical gold and silver, treat it as a form of insurance rather than a speculative bet, and to leave it untouched regardless of short-term price swings. She didn't try to time the market. She didn't check prices weekly. Over the following years, through periods of market volatility, inflation surges, and economic uncertainty, that allocation quietly did its job, not by making her dramatically wealthier, but by providing a stable anchor that didn't move in lockstep with her business income or her equity investments. Her story illustrates something important. For most long-term investors, the goal of holding monetary metals isn't to get rich quickly. It's to preserve purchasing power and reduce portfolio volatility over time, which is a fundamentally different objective than speculation.
Now let's bring everything together, because this is where the pieces we've discussed throughout this video connect into the single most important insight I want to leave you with. Every debt cycle in modern history has eventually reached a point where the math no longer allows for painless solutions. Interest payments consume a growing share of government revenue. Central banks face increasing pressure to keep rates accommodative even amid inflation risk, and the temptation to inflate away debt burdens grows stronger regardless of which political party holds power, because the incentive is structural, not ideological. We are watching in real time documented signs consistent with an economy approaching that kind of inflection point: persistent deficits, a Fed navigating an increasingly narrow policy path, and central banks around the world visibly and deliberately increasing their gold reserves as a hedge against exactly this scenario. This is not a secret. It is not a conspiracy hidden from the public. It is happening in plain sight, documented in central bank reports and World Gold Council data, and in the public statements of monetary policymakers. The reason most investors miss it isn't that the information is hidden, it's that human attention gravitates toward immediate dramatic headlines rather than slow-moving structural shifts that unfold over years. The final insight is this: the movement of gold and silver in the coming years will likely be less about sudden crisis and more about a gradual, ongoing recalibration of how the world values currency itself, driven by the same debt and monetary dynamics that have shaped every major shift in the history of money. Understanding this doesn't require predicting the exact day or the exact price. It requires understanding the mechanism and positioning your portfolio with patience, not panic. So what does this mean practically for you as a long-term investor? It doesn't mean abandoning traditional investments or making dramatic, fear-driven changes to your portfolio. It means understanding diversification, not just across stocks and sectors, but across asset types that behave differently when currency and debt dynamics shift: equities for growth, bonds for income where appropriate, cash for liquidity, and monetary metals as a hedge against the specific, well-documented risks we've discussed today. It means recognizing that volatility in gold and silver prices in the short term doesn't invalidate the long-term thesis, just as short-term stock market volatility doesn't invalidate decades of equity market growth. And it means doing your own research, forming your own conclusions, and never letting fear or excitement from any single video, including this one, replace your own careful judgment. If there's one thing decades of financial history teach us, it's that the investors who preserve and grow wealth over the long run aren't the ones who predict every crisis perfectly. They're the ones who understand the underlying mechanics well enough to stay calm when others panic, patient when others chase, and grounded in evidence rather than emotion. Elena, Marcus, and Priya each learned different versions of the same lesson, that understanding the why behind economic events matters more than reacting to the what. We are, by most historical measures, in a genuinely unusual period of monetary history, one shaped by extraordinary debt levels, a central bank navigating an unprecedented balancing act, and a world quietly reassessing its relationship with the dollar. Whether that reassessment unfolds slowly over the next decade or accelerates sooner, no one can say with certainty. But understanding the forces at play gives you something far more valuable than a prediction. It gives you the ability to think independently, make decisions grounded in evidence rather than emotion, and build a portfolio resilient enough to weather whatever comes next. Stay informed, stay patient, question the headlines, understand the mechanics beneath them, and remember that preserving what you've built is often just as important as growing it. Thank you for watching, and I'll see you in the next one.